Good morning, ladies and gentlemen, and thank you for taking the time to join us this morning for this somewhat late Q2 fixed income update, mostly due to a very full calendar on our side. I'm Davy Karstens, and I'm joined by Henk Kotze, who heads up our fixed income, income and cash teams, as well as Reza Ismail, who is head of our bonds team. For today, Reza will start off with a sort of a fixed income macro theme update. And then Henk will take us through the shorter end of the curve, as well as covering the current positioning in income provider and what the drivers of performance has been over the last quarter. Q2 was actually quite a bad quarter performance-wise, but versus peers, it was a very good one for us. I think it just again highlights the importance of managing risk within the income fund. We did not reach our risk target of losing capital over any 3-month period. So, I mean, we don't bargain on any one asset class to drive performance in the income funds. Reza will then take over and take us through the bond side or our flexible bond fund. As with any webinar, just bear with us if there are any technical difficulties. Feel free to ask any questions on the Q&A function. We will try and cover as many of those towards the end of the webinar. We have applied for CPD points and will be sending out the certificates to everyone that has attended the live session. So with that, Reza, without taking up any more time, I'm going to hand over to you.
Thank you very much, and good morning to all our listeners. It's always a pleasure to be able to address you. And there's quite a bit of terrain to cover, so I'll dive straight into it. So I'll be taking you for the sort of the first 10 minutes or so. I'll just, a whirlwind tour of global macro. Then we'll hand over to Henk, as mentioned. You'll cover sort of the middle 2 slots, and then I'll circle back at the end to give you an update on flexible bonds. But in terms of global macro, I mean, this thing has been said before, certainly has been said before by us. But there's almost never been a time at which macro has mattered more, and we are in a time of unprecedented volatility. And a little bit just to illustrate a little bit of this, I mean, if we just to switch off a couple of things a year, this is a sort of a volatility radar, of sorts. And what it really does is it just gives you a relative idea of various tickers of a year. For example, emerging market FX. G things that's developed sovereign FX. We've got a global, a little bit of a wider set, currency markets. The MOVE index, which is a correlate of the VIX, which essentially marks, bond market volatility in the same way that the VIX sort of tracks realized equity market volatility, of course, stripped from option prices, but it's a coincident indicator of volatility in the bond market. And then we've got the Rand and the VIX there itself, and also the emerging market VIX, right? So what this says is more or less a year ago, that's what the picture looked like, in this terracotta orange color. If we go 6 months ago, you can see there some real volatility rearing its head in terms of the VIX, in terms of the Rand, in terms of the MOVE, in terms of global FX as well, right? But the interesting is that if we look at the current picture, right, which is this one, then we really are seeing something which is quite atypical in markets, in which we are seeing sort of unprecedented volatility in the bond market, right? This is something that is quite atypical, and we can see that on this measure. These are of course Z scores. So of course, really, I mean, a move that is really atypical and quite unprecedented. I mean, it's actually been the highest level of bond market volatility as stripped from bond option prices in the past 30 years. And this is, of course, in the US itself, right? So that is a general context. So the general context is that one of heightened volatility, and this just gives you an idea, of the scale thereof. Now, why do we have this? Of course, any discussion of global macro has to necessarily, circle around the Fed and the Fed's actions. And I'd like to sort of take you through this this table, which we think is quite insightful and quite has a lot of explanatory power as to what has actually gone on, right? So, of course, we have addressed inflation with you on several occasions before. But I think this really frames the decision, or rather really frames the terrain in a very good way. Okay, so what is this? this is a matrix of potential Federal Reserve policy actions. So they have the option, sort of to hike or to hold, at least for the short term. And then on the x-axis on top, we've got the true characterizations of inflation. Okay, so I want you to see this as sort of the matrix of policy actions about 18 months ago, right? Because why I've said 18 months ago is because there's a lot of rhetoric abound that essentially says that, the Fed has actually missed the trick and they're actually behind the curve and they've actually made a policy error, and, Jerome Powell is, incompetent, and a lot of other, kind of aspersions being cast at the Fed, right? But what I want us to do is cast our minds back about 18 months or even about 24 months ago. So the Fed then, this was the time that people said, oh, the Fed was supposed to hike sort of 18 months ago, right? So they had the option to hike or to hold in the face of a characterization of inflation, which was either transitory or entrenched, okay? Now, what were the facts on hand for Jerome Powell at that time? Let's say he decided to hike, right? But the true characterization of inflation turned out to be transitory, right? That would have been a policy error, right? Because he would have hiked in the face of an inflation process that would be rapidly dwindling. So then the risk that you take there is that you hike into an environment in which inflation, although it was influenced by idiosyncratic things, inflation is coming down. And the risk that you run there is that aggregate demand gets permanently crippled, capital formation gets permanently crippled, and you land up in the exact same position that you faced in the decade after the financial crisis, which was of absent inflation. And I find that this is often very missing from the narrative around inflation, is that we almost forget the 10 years or 12 years that we had post the financial crisis, in which the kernel problem facing central banks was actually how to get inflation to actually bite. It sounds very paradoxical in the current context, but that was a very head-scratching issue for the Fed. I mean, there was no sign of inflation in the face of very tight labor markets and in the face of very, very accommodative policy rates. Okay, so the risk was that the Fed was very loath to get us back into that situation that we faced right after the financial crisis. Okay, that would have been a policy error. Okay, if it turned out that inflation was really entrenched, right, that the inflation process had really moved to a new regime, a new much higher regime of wage growth and broad-based price pressure, then that would have been the correct decision. Okay. Alternatively, if 18 months ago, if the decision had been to hold, and we know that this is actually what was done, and the inflation process had proved transitory, in other words, it was elevated for a period of time due to idiosyncratic factors related to the pandemic, but it was going to come down, that would have then been the correct decision. Okay, but where we find ourselves today, and the flux that markets find themselves today, is really in this bottom right corner, right, in which the assumption, certainly the assumption as inferred by asset prices, is that the Fed has in fact made a policy error, right? They have held on. In other words, they hadn't hiked rates 18 or 24 months ago, let's just say, in the face of what is now being assumed to be an entrenched inflation process. And they've now made a policy error, because now you risk the fact that you are almost now, to use that cliche, behind the curve, that inflation expectations has become unhinged, that the inflation basket has become a lot more broad-based, that wage price spirals are sort of taking hold. And that has really what has been rattled markets, right? It's really been this. We're not saying we agree that we are in fact in this bottom right-hand corner, but that has certainly been the assumption of asset markets, that the Fed has in fact made this policy error. Okay, what is our central contention? Our central contention is this: unfortunately, we find ourselves in this position because, number one, you still have a considerable amount of explanatory power for inflation coming from the supply side. Okay, it was extremely unfortunate that thrown into this whirlwind mix was the invasion of the Ukraine by Russia, which added another round of supply-induced commodity side, pricing pressure, right? In commodities, fuels, and food, agricultural produce, that kind of thing. And also China pursuing a zero COVID policy, which also further exacerbated the kind of supply side pressures in the form of logistical chains, again taking a step backwards, right? So unfortunately, all of these things, once thrown into the melting pot, makes it seem as though there certainly has been a policy error, which is not our contention. But again, to repeat it, this has actually been what has rattled asset markets in the recent while. You had the May inflation print coming out, where inflation was extremely elevated, something with the 8% handle. Then you had the June print coming out, where it had something with a 9% handle in the US, and the basket, optically looked as though pressures were widening, right? But coming back to this, and just to close the loop on this, I don't want to spend too much time on this, but remember, hindsight is a perfect science, and your rear view mirror is always a lot more clearer than the windscreen, kind of thing, right? So in the hindsight, everybody is an expert, and in the hindsight, it's very easy to cast aspersions on Fed action and things like that. But remember, what were the facts at hand that Jerome Powell had, 18 months ago? Number one was, at that time, inflation was a result of a very small grouping of durable goods, used cars, used car prices, lumber products related to home DIY, right? Number two, it was the case where all of those price increases were grossly disproportionate to their historical behavior. Number three, it was the case that inflation expectations, even at the height of that durable price goods related episodes, inflation expectations had certainly been still very, very well behaved. And so you throw that into the melting pot, and the evidence which you have 18 months ago provided no compelling case, certainly at that stage, and even we would argue even now, that inflation is here permanently to stay. It was led by a small amount of durable goods experiencing outsized price pressure in the face of massive supply side constraints, massive logistical problems, but inflation expectations, had still been very well anchored. So this was the correct decision to hold, that unfortunately is seeming like a policy error now because of additional factors that have just exacerbated supply side inflation related pressures. Okay, so that's a very important thing, right? Just want to close the loop on one other thing, which is also something we've sort of looked at, and this is this idea of a soft or a hard landing. And this may be a graph which we've shown you before, and I'll end off with this, is that what we've shown here is what's known as the Beverage Curve. So the Beverage Curve plots on a set of axes, it sort of plots unemployment on the x-axis versus job openings on the y-axis. And usually you can see it follows almost this like hyperbola-like shape as labor markets become a lot tighter. It becomes quite hard to actually fill vacancies, and your job openings generally go a little bit higher. You can see this hyperbola-like shape from the period of 2008 to March 2020. But what we can see if we look at the period from sort of the eye of COVID around April 2020 to the latest figure, is that there's certainly been a massive outward shift of the Beverage Curve. You can see that clearly in the gold color points there. So what this means is that there is an unusually high number of job openings relative to a small unemployment rate, right? So for an unemployment rate of 4%, let's just say, you're supposed to hover around there, with a 5% job openings rate or JOLTS rate, right? But you're sitting way, way higher here, with a 7 or 8%, translating to roughly about 11 million job openings in the US. So to put it bluntly, what we are experiencing now is a poor matching efficiency of the US economy. There's a poor matching ability to actually match the kinds of jobs that there are openings for with the available skill set of labor, right? That's the only reason why you have so many job openings, even though you have low unemployment, that are still unfulfilled, right? So the way to really, and part of this is, as we've argued for a long time, is that the kind of jobs that are now being required are high productivity jobs that are unable to be matched by, let's call it, a little bit of a stale labor skill set. So people are not even applying for jobs anymore, else that those figures would also raise the unemployment rate. So they're just not applying for jobs that they feel they don't have the technical skill sets for. So the way to really engineer a soft landing year would be, over time, if an amount of job openings would reduce from the circa 11 million openings that there are at present to something around, let's call it 7 or 8 million, around there, without actually affecting unemployment. So that is what the Fed is really trying to do. It is really trying to cool the demand for labor, right? The demand for labor by trying to reduce the amount of job openings by shrinking the aggregate demand side of the economy, right? So that is what would need to happen. These gold lines, these gold dots would need to resemble something closer to the terracotta or orange type of dots that we've seen sort of into the pre-COVID experience, right? So that is really what needs to happen. Job openings need to reduce, and that is the way to sort of engineer a little bit more of a softer landing. That, I mean, that is almost the Fed's kind of objective, to try and get policy, to normalize policy, to cool the inflation process as best they can, even though lots coming from the supply side, and engineer it in a way that there's minimal disruption to aggregate demand in the economy. Okay, so that is just a little bit of a whirlwind tour of global macro. We've said that, you know, keep the Fed's actions with a long enough timeline, get that context to try and understand what they've actually done. There has been a lot of thought that has gone on to their policy response. This is the kind of issue that they are faced with. And just circling back to the beginning, we are coming out of a period that has seen almost unprecedented volatility in fixed income markets. So with that ado, I will hand over to Henk, and he'll take you through the local fixed income macro scene.
Perfect. Thank you, Reza, and good morning, everyone. It was certainly nice to chat to everyone again. As Davi said, slightly delayed Q2 update. That is not, we didn't engineer it specifically because of the softer quarter we had, but certainly since then we've seen some traction back in some of our performance in the funds. Really speaking back to what Reza said, markets getting to grips more with what the inflation story looked like. If you look at yesterday's US inflation print, softer than expected, and what's key for us, and again, what highlighted by Reza, really across the board, softening in the monthly numbers. So yeah, good to see. Obviously a good day for SA and risk assets yesterday on the back of that. Okay, so let me just try and get back into the front end of the yield curve, and where it's obviously a little bit more appropriate for us on the income side. There we go. And obviously a lot's happened since we last chatted. We were fairly firm on our view that what our market was pricing from an interest rate hike perspective, or hiking cycle perspective, was quite aggressive. We still hold that view. Obviously what we saw in the June meeting or July meeting was a 75 basis point hike by our treasury, or our SARB, and certainly higher than we expected. But it's interesting to see how the curve reacted post that, and I want to try and show you some of that. Yes, on the headline number on 75 points pricing, it is quite a move, but the rest of the curve actually went and did some interesting things. So what we're looking at here is just the FRA curve. So again, what the market expects for our interest rates going forward. So let's just switch off some of these, and very interesting to see. So this is a month ago when we so sort of when we would have last chatted, and that's obviously the move we saw, the 75 basis points to that point. But what's very starkly obvious here, and what we are seeing, is this happening. So the market is starting to take off that aggressive sort of pricing of hikes going forward, and it's really on the back of what we're seeing in the US curve. So very interestingly for us. So this is as of last night, so you can see some strong movement in the South African context here. But this is just a similar chart to the previous one. So the blue line in the previous graph, what our market expects for our interest rates, and then what the US market expects for their interest rates. And very interestingly, as you can see here, the market is starting to price aggressive rate cuts in the US, where in our market not really yet doing that. And we are the contention that certainly our treasury and our SARB and our MPC do follow the Fed quite closely, and even this sort of pricing here for us is fairly aggressive, and we should start to see this come off. And as I said, we have started to see that, and we saw some performance come back into the funds, and certainly this movement here from over there to there in the sort of 2-year area of the curve, certainly aiding the funds and sort of speaking to our view that what we are seeing from a pricing perspective is fairly aggressive. And just then one last final point, if we come back out to the back end of this year, so about 6.9. It was yesterday closer to 7. What the market expects the repo rate or JIBAR to be at that point in time. If you then circle back to what the SARB is actually saying, and if you look at their sort of quarterly projection model or QPM model, that model is telling them to not hike anymore this year. So that's got the JIBAR rate at about 5.9. So very little movement in that. So again, aggressive pricing, something that we probably won't see, and the market is sort of getting to grips with what we are seeing in the US context and what that means for South African interest rates. Okay, so then moving along swiftly, what has changed in our portfolios and how have we dealt with sort of these increases in rates, and taking on some exposure that I mean, certainly do think there's a lot of value in, but we were constrained, as Darby very eloquently stated at the start. The way we think about the income fund and how we measure our risk and how much risk we can take helped us to not breach our risk target, and really gave us the opportunity now to enter the market at a point where we think there was some value. So I'm going to take you through that. We're going to go a little bit behind the scenes and show you our risk budget and how we do things. It might get a bit technical, but we really wanted to give you the nuts and bolts of how we measure our risk, how we make sure from a systematic perspective that what we have in the portfolio is sufficient in terms of risk addition, and it won't breach that target of ours. It's very important for us to always keep that risk target in mind, and it's really something that sets us apart from our peers, as Darby said at the start. Okay, so what has changed? So what we're looking at here is just the back end of the bond curve, and Reza will go through this in a little bit more detail. But what's changed from last time is the bonds that we want to own in our income fund. So previously it was one of the 186 bonds, so basically a 4-year bond and a little bit of the 2030s, and now it wants a little bit of back-end bonds as well. So how have we done this from a positioning perspective, where we saw some risk budget opening up? Sorry, apologies for that. We were able to shift from the sort of front end of the curve a little bit more into the back end of curve, add some duration, and obviously that has aided the portfolio in the last little while. So I'm just trying to get that cursor out of here. You have any idea how to get this thing away? Nope.
Okay.
Sorry, guys. As Darby said, bear with us with some technical detail here. Okay, just as I said, let's go behind the scenes and talk about this risk budget that we keep mentioning, we keep alluding to. Now we've got it live, we've got it up and running, and certainly credit to my team who's done a lot of excellent work around this, and for us to be able to showcase to you today how we think about risk, how we take the risk, and how we actually measure the actual risk that we are taking, and that it's aligned with how much risk we want to take in an income fund specifically. So to give a second to load. So when we're taking on exposure, as Darby said, we're always trying to find the different drivers of real return that we can use in the income fund. But when we are adding these drivers or the different return or compasses that we call, what you can see here, those do add risk. So what we know is we can buy inflation-linked bonds, we can go offshore, there's preference shares, there's property, there's some shorter term money market assets, then there's some bonds all the way out to the 10-year, and then there's some credit. So this is just to show you the data that we have, how those different instruments or asset classes that we can buy, behaved in the different crises that we have seen. And if you just hover over the property, you can see obviously quite volatile, specifically if you look at the COVID episode. So this just gives us a sense of how these asset classes perform through crises. But what's more important for us, as Darby again said at the start, is this rolling 3-month risk target or mindset that we have. So then if we overlay that in and have a rolling 3-month return of these asset classes, this is what the distribution would look like. And again, I will just switch off some of these to give you a sense of how these guys will operate through time. So just again, property and prefs, you can see preferences a little bit more condensed in terms of the distribution of return, where property has these sort of tails that you always want to try and avoid. And if you then add some, where's this credit one here? You can see not that volatile, but nicely grouped. So once we have all this data, this is just rolling 3 months through time, just to again give you a sense of how property does over 3 months, and then all the data that we have. So once we have this and we have the total returns and we know how these guys behave through different cycles and through rolling 3-month periods, we can go and then take the current portfolio that we have and apply that portfolio and the risk that we have in that portfolio to the current or to the data that we've now showed you. So again, if we look at the current portfolio, how the portfolio would have done through or in these crises, you can see in that total bars that I'm showing you now, only really 2 episodes where it would have not done well. Again, COVID and then taper tantrum, which was in June 2013 when Bernanke sort of started tapering its bond purchases. You can see, so from this gives us a good sense and comfort to know that the current portfolio would have only seen drawdowns in 2 episodes previously. So that's the first tick, right? The second one is then to say, okay, if we have 3 months of return that we don't want to breach 0, what does that mean from a budget perspective? So there's a number of different ways we can think about this, but we want to think about all of them at the same time. So what are we doing? So we're saying the fund has yield that we've built into the portfolio. That's the 3-month yield dotted red line you can see over here. Then we've got return that we've already made. Okay, so that would be either 1 month return or 2 months return. And then we will have all 3 lines. So the combination of those 3, yield looking forward, return looking back, giving us a sense of how much budget we have to spend. And then we apply the risk that we have in the current portfolio to those lines. And you can see currently 99% confidence level is this black line over here, 99.9% over here. And you can see we're not breaching any of those lines. So from a risk perspective, we're very happy that we've taken enough risk, but we certainly haven't jeopardized our risk target of not losing money. Just to give you a better sense here of the total. So this is what the expectation of the current portfolio is in terms of looking back of the composites that we hold or the assets that we currently have in the portfolio. You can see very nicely distributed to the right here, which is one of what we want to see. And if even on the tail side, as I said, the risk that we measured, the amount of risk we can take, we're not breaching on that line. Just a final, just want to switch these guys on again, give you a little bit of a sense of how the combination of these assets in the portfolio, you can see how the distribution of the different asset classes sits to the left and the fund itself to the right. And that's what we want to try and see when we were diversifying asset classes, a nice positive distribution to the right. Okay, then just one final one. There's obviously also the month-to-date numbers that we have to think about. Okay, so this is the final one we look at. So what we have currently made to this point in the month, what we can still make in terms of yield for the rest of the month, plus 2 months return. That's this red line. And you can see again, very nicely between the 99 and 99.9% confidence level. Just again, showing us that we're surgical when it comes to managing our risk. We calculate this risk. We know exactly how much risk we are taking, how this risk would have reacted in different scenarios, different crises, and then also over the rolling 3-month periods that we have going back to about 2000. So that's on the risk side. Just want to, as I said, show you behind the scenes, a little bit technical, but rest assured, as I said, we are very surgical when it comes to thinking about risk. And when we're applying this to the portfolio, specifically on the income side, we make sure that we don't have those drawdowns over a 3-month period. And then very quickly on the fund positioning side, as I showed you, the composition of the bonds that we want to hold has changed, and that really is on the back of how the markets moved. So to give you a very quick update on where we are from a fund perspective, we forward-looking yield of about 8.62, very healthy, certainly a lot better than what we can expect from a money market, and also a lot better than if you think back post-COVID where we were from a yield perspective. And then this number is very important here. So when we last spoke, it was around 1.27 or 1.3. We saw some risk budget open up. We saw some opportunity in the bond space, and we pushed this to 1.5 back end of last month. And certainly that trade has worked well for us. Okay, and here you can just see this composition. So the 186s that we've reduced, we've added some 2030s and some 2037s on the back of the optimal allocation that I showed you. Perfect. So that's it from my side. I'm going to hand back over to Reza to finish off on the bond side, and then leave some questions for the end. Thank you.
Thanks very much. Yeah, so one of the things that I think in previous episodes we certainly did cover with you is this little diagram, or actually a living, breathing animal, actually, but this dial over here, which certainly for the bonds and for many other asset classes, just gives some indication as to what your portfolio stance should be, right? So moderate overweight, if we just strip out all the jargon, it means that you want to have some active duration. Neutral would be bang on in terms of all-B duration, let's say, for a bond portfolio. So moderate overweight, you want to have some active duration, not certainly as much as if the dial was in strong overweight, but certainly you do want to have an active footprint, right? And this in turn is the end product of our sort of our multi-factor system, which we have explained before, but just to go over it in a couple of sentences. I mean, we look at 4 chief sort of meta factors, and those relate to valuations, economics, financial conditions, and sentiment. The valuations one, I mean, in days of old, don't phrase it like that, but that just speaks to how high yields are, right? So previously you might have had sort of rules of thumb, which says that, buy bonds when yields are very high, and sell bonds when yields are low. And if you have if you're indifferent between the two, try to keep sort of like a neutral-ish stance, right? There's nothing wrong with that. But what we do find was that such rules of thumbs can be outperformed by, informing your trading rule by something additional to valuations. In other words, by adding factors related to economics, related to financial conditions, and related to sentiment, in addition to looking at the absolute level of yields. Okay, so what does it mean now? It means that taking all these things into a mix, and I won't necessarily go into all of the sub-factors, but just saying that we look at economic factors, we pick up data points in the real economy, we pick up deviations from consensus estimates of those data points, we pick up things related to financial conditions, which is also a broad topic, but relates to monetary policy, credit spreads, funding pressure on the banking side, and the appetite for dollars in global funding markets that's measured by the cross-currency basis. And then we also look at factors related to sentiment. So you throw all that into the melting pot, and it says, okay, guys, I think the appropriate and the optimal stance now is to be that of having moderate overweight. So how do we digest this information, right, into something that makes sense for a portfolio? Is something that I'll spend a little bit of time on. Okay, so what we've now done via this tool, I think, how did we do this? Okay, right, via this tool, and let's just have a look at it. So sorry, if you just give me a second, right? So what we've done here, let me just maybe take off some of these things and leave one of them, is that we've said that, okay, let's filter out all the times in the past, right? And this stretches back to a period, at least over 20 years, that the portal score has been strong overweight. You can see you'd recognize these labels here: moderate overweight, strong overweight, neutral, and so forth. We filtered out on those states and said that what is then the ex-post realization of the yield curve. In other words, what really happens to the average level of the yield curve given a state, right? So in all the times that the portfolio has had, that the dial has been in strong overweight, what actually happens to the yield curve over the next year on average, right, to the overall level? Okay, so the idea here is that we obviously want to see some compression, else the model wouldn't have any value at all. So in the strong overweight, we want to have a distribution that has a mean value that indicates some kind of compression, right? And that is exactly what we see, right? So in the same way, we've got distributions for all of the states, and we can really investigate the kind of probability distribution given particular states. So as you would remember from just a page ago, we are sort of in a moderate overweight state. And this is a simple box and whisker plot of what happens, in various states. Of course, in the strong overweight state over here, we have a medium compression of around 50 basis points, which which stands up to logic. Now, the somewhat counterintuitive thing might be this plot over here, which effectively says that even in strong underweight scenarios, we do see some compression, and we're not shying away from that. But it actually makes good intuitive sense, because you've had two major eras in which we've had a strong underweight. So that was the dot-com crisis in early 2000, and then the global financial crisis in sort of 07, 08, 09. And both those episodes in which the dial was strong underweight, over the next year, what happens, you see a material compression of the yield curve, right? So that's what actually happens, in the year following the score, the score on the dial being sort of strong underweight, right? But be that as it may, so what we can do is that we can actually see then, if I go here per bond, I know this is a lot of data to digest, but very, very simply, it effectively shows you what different bonds on the term structure do under different types of yield curve shocks, right? So obviously the 2048, which is an ultra long bond of a very high duration, obviously it's going to do very, very well if the yield curve compresses by 150 basis points. You're going to get something in the order of a 25% return, that kind of thing. Obviously, if it sells off, the reverse is in play, right? So what we can now do is that sort of we know what different bonds do for different shocks, but now we also have a probability distribution around those shocks. We actually know what's going to happen given a state, on average, given the empirical probability distribution, right? So now we can calculate a specific return for a bond, right? So this is almost like the average return that the 2048 will return if the dial in the model is strong overweight, okay? The average return is about 19% for 2048 when the dial is in strong overweight. And similarly, for other states, let's say the dial was in moderate overweight, you can also figure out what the 2048 will do on average, because we know what the yield curve will do on average, because we know we've got information about the empirical distribution here, right? So it's all very scientific. I like the word that Henk used a little bit. It's very surgical and very systematic, right? So what it looks like is something like this. So when we are in the strong overweight model state, we've got a distribution of what the yield curve potentially does over the next year. And this is indicated sort of in the background here with the gray distribution in the back. And then we've just chosen arbitrarily two bonds, a 2048 and sort of a belly bond, a 2035 bond, to sort of give you an idea of what the bonds will do. So what we can see here is that a mean compression of about 50 basis points, if the model is in strong overweight, sort of shows you that the 2048 will do about 20.7%, the 2035 19.7%. Of course, on the right tail here, this indicates more compression, right? More compression sort of on the right tail here. And obviously in those scenarios, the 2048 materially outperforms because of its better duration and convexity attributes. Conversely, on the left tail here, these are adverse outcomes given a strong overweight state, right? These are adverse outcomes. In other words, these are low probability outcomes. In other words, the yield curve selling off by 100 basis points or by 200 basis points, given that the model is in strong overweight, right? So that's what this is really saying. So this model, in a probabilistic sense, is not saying that you can't have a sell-off of 200 basis points, but it is saying it is statistically unlikely to experience, based on being in this tail, a 2% or 1% sell-off in the yields on average if the model is in strong overweight. So what we've exactly noticed now is essentially, in statistical parlance, a tail event, right? Where the model was in strong overweight, but we saw this kind of phenomenon here where the yield curve sold off by 200 basis points, right? But actually, even in that state, the long dated bonds don't do too badly. So we, of course, are not in strong overweight now, we're in moderate overweight. And as one would expect, the distribution moves a little bit, quite hard to actually tell that, but if you keep your eyes slowly on the gray area, you notice it moves slightly to the left, meaning that has the probability of a very strong positive outcome, has that probability decreased? Yes, it has. Has the probability of a very adverse outcome, negative outcome, yield curve selling off, has the probability of that increased? Yes, it has, right? But what we've got to look at is we've got to look at the range of outcomes and not a single outcome. We've got to look at the entire distribution and say, okay, which bond, right, really outperforms if we take the full set of probabilistic outcomes. And it turns out that the 2048 is still the bond that outperforms. And we could see that a little bit earlier on, from this chart over here. So even in moderate overweight, the state that we are in there, we actually find that the 2048, sort of the back-end bonds, and we do very, very, very well, even though we're in a moderate overweight state, and sort of not a strong overweight state. So that gives you a little bit of a window into exactly how we are positioned and the kind of probabilistic modeling we do to sort of determine what the optimal position is to be on the yield curve given a state, right? So very systematic, very surgical. Okay. One other thing, and I'll close off with this, is that obviously when you have a situation in which, like we found sort of in May, June, and sort of to a little bit of early July, whenever you find a situation, in which bond market weakness, right, is informed by panic about an inflationary impulse, right? What you generally find is that break-evens widen, right? So the nominal bond curve sells off because it wants more compensation for the perception that inflation might be higher in future, right? At the same time, appetite for linkers becomes increased. People want inflation protection if they assume that inflation will get out of kilter in the future. So what then happens exactly at this time, and as we can see, this is our indicator of the relative value between nominal bonds and inflation-linked bonds, right? So when this blue line here, when this navy blue line is sort of in the pinky reddy area, you want to have a tactical preference for nominal bonds. And if it's in the lilac area, you want to have a tactical preference for linkers. But as you can see, as of early this year, unambiguously, this line has been in the pink area, meaning that we should have a strong presence in the portfolio, strong exposure to nominal bonds, because they are giving you better implied inflation compensation. In other words, they've sold off to such an extent that it's really offering very, very compelling inflation compensation. And if we think that the Reserve Bank is credible, which we do, the SARB is very credible. They've got a very, very credible reaction function. They act timeously. They've got good forward guidance, good communication, very transparent rules around how they adjust policy. So there's no reason to doubt the credibility of the SARB. Then when you have situations like that, you can with full confidence espouse positioning in the nominal market. And that's exactly what we've done. Obviously, when you do that, there is the risk that you sort of enter nominals and it sells off even more. As we've seen there, linkers become more expensive, bonds become even cheaper post the period in which you sort of enter the trade. That's quite normal and quite typical of how break-evens typically work, but it's still the right place to be. And we can see as of now, as of yesterday, those break-evens have come all the way back, and we've made up a lot of ground, in the past couple of days alone, right? So the positioning has certainly paid off, and we think that this is still a very good systematic tool to inform our portfolio stances, right? So we will really close off with that. So the positioning is really that of still wanting to espouse active duration. We still think the global environment is still, has a lot of green shoots and a lot of upside asymmetry for risk assets. And that's why we are circumspect of things that can go wrong. Like we said, I mean, there are a whole lot of things that can happen to financial conditions and things like that. We are, quite circumspect about the things that can go wrong, but we build that in terms of looking at the entire distribution of things that can happen. We build that in by looking at the probability distribution, and it turns out that the current positioning is still optimal, even though the dial has moved from strong overweight to moderate overweight. So we'll pause there, we'll round off and end off there, and we're very happy to take questions, as they come along. Thank you very much for the time.
Thank you, Reza and Henk. I think that was insightful. I hope everyone else enjoyed it. There are a couple of questions. I think I'm having some technical difficulties. So if I do disappear, please go on with the questions on the Q&A there, Henk and Reza. Maybe in layman's terms, why has Q1's performance on the income side been so bad? Break it down. So I don't know if you have got the contribution there. And then why is the outlook for, say, Q3 and 4 looking better, or why should we expect better returns coming from the income side?
Yeah, so I mean, I think let's take the first half of the year versus the second half of what sort of the year that's coming. So I mean, if you look at the actual return of the portfolio relative to the yield that we've built into the portfolio for the first 6 months, In layman's terms, the real reason for why there's a bit of underperformance to that is that we've locked in the yields. And as Reza said, as you see value and you lock in the yields, sometimes they get even cheaper, or there's more value. And that's certainly what we saw as global bond markets kept selling off. The mark-to-market impact of those positions in the portfolio detracts from the actual performance. And as that comes back, you see the acceleration in the back end of the year. So certainly if you take July and currently August month to date, we've seen a lot of that performance come back. And we certainly do think that the back end of this year, there's a lot of performance that still can come back. What's very important to also understand is, yes, you see a bit of lag relative to the yield in the portfolio. But if you don't have any defaults, there's no permanent mark-to-market negative impacts or losses in the portfolio. And fixed income instruments always mature at par, so that always pull back to their par level. So in time that comes back, and that's what we are seeing. From our perspective, yes, it was a slower second quarter, but we do think there's sufficient yield built into the portfolio, sufficient risk management, and certainly some very good upside expectations for the back end of this year. Darby. So we're going to take over the questioning here. Okay, so the second question around the tool that we are presenting from, this is our online portal. And the question is there an opportunity, or is there plans to make this available wider than internally? There certainly is. There's talk around trying to get that out there for clients and people to log into this, to have a lighter version of this. There's obviously some very important sort of caveats to that. This is our tool that we've built internally to aid us in managing our clients' money, to position our portfolios and really be ahead of the curve in what we want to try and do. And we have to make sure that this thing is right all the time. So to spend time internally rather than externally is important for us. But yes, certainly there is talks around trying to get this out. It is very useful, and certainly be a very, very good value add for our clients. Cool.
The rand question for you.
Stressing that the rand strengthened 1620. How did this affect the offshore exposure? So the offshore exposure, interestingly, again, if you think about sort of the risk drivers in the portfolio on the income side, we want duration. There we have duration, and we also have some offshore exposure that increases our risk. And in the offshore space, we've had duration exposure as well. And if you think about sort of the worst performing asset class year to date, has certainly been emerging market fixed income. We've seen extreme sized offshore selling off. Reza started off with the volatility sort of plot to show you how atypical that is. We've seen some of that come back. But the way we think about offshore in the income provider fund specifically is to really take exposure to South African counterparties that we know well. That's mispriced in the offshore market. So SA banks as an example, and the government. And then we hedge out that currency exposures. We don't take dollar exposure. When we go offshore, we hedge it back into rands. And that's very simply because we get that interest rate differential, the pickup for selling the dollars and buying the rand forward. So the difference in the two interest rate is what we earn. And if you compare that then to a local asset in rands, there's certainly some value. So, we don't take that currency exposure. So the question around what does the strength in the currency mean? Really, the strength in the currency for us is an indication of risk on, and the risk exposure in the portfolio should do well around that. It won't be specifically to the rand strengthening, but certainly from a risk dial perspective that aids the portfolio. How do we then do? So we do take exposure to currency, but from our perspective, it would be on a sort of minimizing risk in the portfolio. So it would be a hedge against some of the risky assets. And currently, again, to the volatility sort of plot, it's very expensive to buy protection. And we just don't see the value in doing that. So currently, we know protection in the portfolio from a currency perspective, or the dollar exposure hedge back into rands. And if I look at that component of the portfolio and the yields that's represented there, certainly one of the key drivers for the next 6 months for us.
Okay, I'll take the next one. So Dean's asked a great question there. So Dean has asked why, in the analysis that I showed about probability distributions, why are the returns higher for strong underweight? That's a great question. So to answer that, I mean, there were certain trade-offs which were at our disposal when we conceived of this analysis. The first one would essentially be to keep the probability distributions exactly the same as what the empirical reality was. In other words, the distribution conditional in the state is what really actually happened to the yield curve, right? So that is an empirical distribution with its warts and all, that has a number of skewness and kurtosis defects and all of that, but we've kept that intact, right? The other option would be to say each state has got a set of parameters, and let's just plot a theoretical normal distribution of outcomes given some parameters. Now, what happened is that because we've favored using the actual empirical reality, you had two major episodes, as I alluded to, in the early 2000s. So you had the dot-com crisis, in which the model was in strong sort of underweight, but over the next year, what happened to the yield curve? Remember, this was pre-South Africa getting into the WIGB. You saw the yield curve compressing by 300 basis points. Similarly, at the time of the global financial crisis, the model was again in strong underweight, but then what happens is that the model then the yield curve then compressed by around 150 or 200 basis points in a year after the financial crisis. So those two things pulls up the average, or rather pulls down the average of what typically happens in strong underweight scenarios. It almost seems to give the idea that in strong underweight scenarios, you actually do experience a material compression, even though there were two outsized events. Now, we're toying with the idea of excluding those events as atypical, but we want to also include them to be a truer reflection of reality, in the sense that you can have compression when things are looking quite bleak. We can obviously make our models more more pleasing to the eye by excluding those episodes, but for the moment we've kept them in, just to show you that the engine is working and is picking up the true reality of what happened.
Cool, great. Then a good question again from Clem as well, just around sort of the theoretical analysis and the things we've done around the risk and the model return, and what has our actual experience been from a return perspective. And I'm going to try and get back to that page. This is probably the better one. And that, I mean, that's a great question, and we haven't plotted it on here yet, and it's certainly part of the plan. But if I go back into the data that we've run and look at all the asset class returns through time, sort of the expectation of what those returns would be, and I plot the actual performance of the portfolio, the portfolio sits very nicely to the right of the actual composite. So one saying that the combination of assets has done better than the assets itself, and certainly the way we thought about risk and managing that risk has reduced that left tail. So actual performance through time since inception of the portfolio relative to the actual underlying components in the data and the modeling has shown that the sort of process has worked, and the return distribution. So this is what I'm talking about. So this is all the asset classes that we could have held through time from a 3-month rolling perspective. And then what we see, and as I said, we haven't plotted it just yet, the portfolio return sits around sort of that area over there. So, the actual experience has been what we wanted to see, and sort of shifted to the right, or at least the distribution to the right of that. Okay, let's get back to the questions. SARB credibility.
I'll take that one. So with regards to this question about nationalization of the SARB, right? So, I mean, at face value, I mean, if this was, certainly in terms of our view, if this was a genuine possibility, then yes, it is a significant reason to worry, right? If you remember back in the days in which we were looking at downgrades and all things like that, you remember that across the board, Moody's, S&P and Fitch, one of the redeeming features of South Africa's sovereign score was the strength of institutions, right? And particularly the legislature and particularly the Reserve Bank, right? Those were two very strong areas that counted massively in our favor for keeping us investment grade as long as we did, right? So as soon as you start compromising that, I mean, the slope downwards is extremely slippery, okay? And if we think about why really are these noises being made about SARB nationalization, it's really one of two things, right? It's those on the outside with a false perception that the SARB has got a big balance sheet, right? And there's somehow or another, there's balance sheet assets that can actually be dispersed, sort of distributed to the masses, right? That is an incorrect assumption, right? People think that there's some loot that the SARB has got there that should actually filter down to the working public. That's wrong, okay? The second thing is that people assume that by nationalizing the SARB, that, you know, it's going to be a one-way ticket to permanently easy policy rates. In other words, permanently low repo, right? But what would that do? The only thing that that would do is that we would lose control of the inflation process, and that would hit the poor the most, right? So remember, if you lose control of the inflation process, interest rates at its basic level has to compensate you for inflation. So it would mean then that low policy rates would mean higher inflation, and ultimately would mean then higher interest rates again, right? So I think that the kind of noises where this is coming from, that, you know, do not necessarily have you know, the foresight to understand what they are really asking. You know, the people that would be the ultimate sufferers of a nationalized SARB that has you know, a more looser policy outlook would be the very poorest of the poor, right? So I really question whether that could really get off the ground, and really what those making those noises would actually wish to achieve by that.
Cool. And then Dean, again, around sort of, have you modeled the effect of the country being placed on the grey list? And we assume you mean the banks that's been placed on the grey list around sort of FATCA. I mean, I think that really what it's similar to the SA context or the government, where we have very little dollar debt that really can expose us if something goes pear-shaped around perception for SA in the global markets. Similarly, our banks have very little funding that they require and that they raise in the offshore market, and that's really where the impact should see or would come through in the sort of the pricing around dollar debt for our banks. And we don't really see too much of an impact on that. It's something certainly that's on our radar, and some work that we are doing around that. But for now, we don't see too much of a risk around pricing from that grey list place. And then to Clem, yes, certainly we'll get the numbers to you guys, get it through Darby to you around what we've sort of said today, and around the modeling and the charts, etc. Okay, the grey list, I think I've covered that, unless you want to add something. No. Cool, and then it's just a thank you. So thanks from all of us as well. Really appreciate it that you've dialed in. I know some a little bit more technical than some of our previous ones, but as I said, we really wanted to show you the nuts and bolts behind the scenes, how we think about things. It's very important to understand how we think about markets, risks, and really systematically breaking down the different drivers, really understanding how to take risk and how we do it, and just to try and showcase that to you guys. So thanks again, certainly from myself and yes, from Reza as well.
Thanks very much. It's always a pleasure to address you guys. Thanks very much, guys.